Thank you for joining us today. We hope you and your family are healthy and faring well during this crisis. I'm joined today by Adam and Andy, who will address the economic and investment implications of our current environment. Before we launch into that, I want to share a quick COVID-19 update. Adam, thank you. We in much of the world have achieved significant curve, quote unquote, bending via our social distancing and stay-at-home orders. In fact, states and many countries are beginning to reopen their economies. Domestically, South Carolina, Georgia, Tennessee, Florida, and Ohio all plan to ease restrictions over the next week to 10 days. Testing capacity is improving, but uneven across states and countries. This week's stimulus bill provides federal funding specifically for testing. We're also finding effective treatment options, including especially Gilead's remdesivir, hope I said that correctly, with very promising early signs. And then finally, we have vaccine trials here and around the world that are all progressing and showing early lines of success. So mostly positive news on a relative basis on the COVID front. However, we have another disruption in the market, which is the oversupply of oil and its resulting price collapse. Made big news when futures briefly dropped below zero. So who would have ever thought we could have seen negative interest rates and negative pricing for a barrel of oil? But it's, driving this is the oversupply and the fact that the world is now running out of storage capacity. The OPEC Russian agreement to lower production is the solution to this in the longer run, and I'm certain that this will eventually sort itself out. But I think we can expect depressed pricing to persist until demand increases, and that'll occur when there's greater economic activity. So. And as you can see here, oil dropped down towards $10 yesterday. It's back up around $14, $15. All but the lowest cost producers are challenged by pricing in that range. So hopefully the worst of this is also behind us, and we can look forward to recoveries ahead. So I want to pass it now to Adam.
Thanks, Lowell, and good afternoon, everyone. We're going to do our typical recap of quarterly activity in financial markets and the economy, and we're also going to try to look ahead, especially given the list of uncertainties and essentially daily developments at this point. So our goal is to keep the whole presentation just around 30 minutes, but if we happen to run a little bit over and you've got to hop off, don't worry. We're going to have a recording posted probably in the next day or so that will be distributed to all of our clients, as we've done with past webinars. So that'll be available shortly. So let's get started with market performance for the quarter. Given the global spread of COVID-19, all the major stock categories dropped into what we call bear market territory in March, less than a month after reaching new all-time highs. And a quick reminder, the definition of a bear market is a decline from top to bottom of 20% or more. Markets domestically dropped from their peak into bear market territory in only 16 days. So this was the fastest downward correction on record. For some context, the second fastest bear market occurred in 1987. It took about 39 days, while the first 20% decline during the global financial crisis from 07-09 took just about 200 days. And so while the timing of the drop is significant, another important aspect of it is what are the average daily price swings that we experience as we're on our way down. So in March, the average daily fluctuations were just over 3.5% per day, while in 87 they were about 1.5% a day, and in 09 they were, I think, just under 1%. So not only was the decline significant and historical in terms of speed, but also its daily volatility. And there were several catalysts for the market swings as news was unfolding, and investors were trying to start to begin and think about taking action. The first wave being the initial shock from the scale and the projected impact of COVID-19, and the second was a liquidity crunch, which caused correlations to rise across most risky asset categories. And this happened as investors were trying to sort the landscape and began to favor cash over stocks and bonds. So these liquidity crunches often occur when there's what we call panic selling across many asset classes that results in a high volume of investments being sold, but in a very short window of time. And this was particularly painful not only in the stock market, but also the bond market, as we saw short-term yields spike significantly at a time when investors were relying on bonds for stability. But overall, if we look at the full quarter, the higher quality bonds you can see it were in positive territory and did provide a relatively safe haven as they historically do in bear markets. So even with record low yields coming into this, investors that had exposure to bonds were provided a pretty positive offset to losses in their stock portfolios. And it's important to delineate and differentiate high quality bonds, which are considered investment grade, to junk bonds, also known as high yield bonds, which exhibit stock-like volatility in these kinds of markets. And we certainly did see that. It's just a quick snapshot, taking it outside of the quarter and looking past the rolling 1, 5, and 10-year periods. You know, you hear a lot of talk about the impact of rolling returns after this short-term sell-off. And one of the things we've highlighted pretty regularly in our quarterly calls in the last year is just the return disparity in the stock classes, in particular, the large spread between domestic and global equities over the last 10 years. And this is translated at the sub-asset class level between large versus small and growth versus value. So there's been, coming out of the last recession, some significant return gaps, as we call them, that have really been persistent, even leading up to the recent quarter end. One other thing that I thought was interesting and I wanted to share, and it helped put some perspective into the concept of the magnitude of the daily volatility we experienced is, this is a chart that's looking at 3 market scenarios from January 1 to just almost the end of March of this year. So the black line here is if you had only been invested on the up days during those 3 months. The red line is if you were only invested on the down days. And the gray line is if you were just fully invested through the period itself. So this is using the S&P 500 as a proxy for the stock market, but it really, I think, emphasizes not only the magnitude of the swings, but it also illustrates a lot of the pressure that investors who were trying to time the market, what they were faced with. So with daily fluctuations of nearing 4%, we had very sharp down days, often followed by really big up days. And so Andy's going to put some context behind managing through this versus trying to manage around it. But this is something we can likely, expect to be somewhat of the norm going forward. Maybe not on this magnitude, but short-term periods of good followed by bad. And we've seen some of that play out this week already, especially. So from an economic standpoint, with COVID-19 spreading globally, it had some immediate and pretty significant economic implications. So what had been a fairly long-running late cycle phase for much of the world economy quickly turned into a recession. So while the progression of the virus wasn't uniform among countries, it was moving, really from Asia over toward to the U.S. The shutdown of travel and other activities negatively reinforced the global nature of the shutdown in a fairly quick fashion. And so once things got over to the U.S., we had a sudden stop nature of the downturn, and it was a little bit unusual and dramatic, and it was reflected in the early data that we have. So this includes near record levels of unemployment coming into this being reversed abruptly. So we had new unemployment claims, which immediately surged to record highs, with the first wave of unemployment claims post-COVID shutdown being many multiples the previous all-time highs. So this was expected, given the intentional nature of what we were doing as a country, but it was still shocking to witness nonetheless. And industries that have been most directly and immediately impacted, such as travel, hotels, restaurants, they account for about a fifth of U.S. employment and economic output, and they saw demand drop to near zero. A storm that very few were financially prepared to weather, and a big catalyst for a lot of the stimulus we're going to talk about in just a minute. But on a positive note, as this was unfolding quickly and rapidly and disrupting all of our lives, the bright end of this was that U.S. monetary and fiscal policymakers, I think, responded pretty rapidly to address the potential deterioration of financial conditions. So the Fed and their role was they immediately cut policy rates to zero and announced a handful of new facilities that were designed to really improve liquidity and help flow cash into the market. The Fed, they also initiated, again, pulling from the 08-09 playbook, open-ended quantitative easing that's going to likely end up adding trillions of dollars to the balance sheet, but again, necessary in the short term. So while the Fed acted, the government also stepped up and did its part as well in very quick fashion, passing legislation to provide just over $2 trillion of support to healthcare relief efforts, households, businesses, and as Lowell mentioned earlier, another $500 billion or so about to be pumped into this program in short order. So the size and scope of both of these efforts were absolutely unprecedented. And so I think the takeaway from that is we learned some lessons from what happened during the great financial crisis. We've been able to do this in record fashion. So things that took months and weeks 10 years ago, we ended up knocking out in a matter of days, and if that, a week. So their jobs are far from over. I think there's probably three things that are still out there unresolved that they'll be keeping an eye on and communicating to us proactively and clearly around. The first being the medical solution to COVID-19. We're seeing the medical world begin to collaborate in unprecedented ways, and we've seen the market react positively to developments around certain drugs, as Lowell referenced. That's number one. Number two is just the plan to reopen the economy on a national scale safely and with testing. And then the third being beginning to actually quantify the economic impact of the virus. So for this list of reasons and everything mentioned before, looking ahead and trying to estimate dollars and cents of the lost activity or the impact on GDP becomes a very, very difficult exercise. So current estimates for Q2 GDP range anywhere from a 15 to a 33% contraction. So we're expecting in an intentional fashion, in a planned fashion, a really brutal second quarter. So, and this is why you're seeing markets not really flinch to some of the numbers that are rolling across the tape, because things like the high levels of unemployment, poor manufacturing, auto sales, all of those things are very much so expected. So I think a lot of the focus is going to start to shift to Q3 and Q4 and the reopening of things and the medical solutions to this, and quantifying how we get back to growth mode. So so we now know, I think, if you look at the Fed and what their role is in this, just to emphasize the uncertainty, at their March 15th meeting, they refrained from releasing any economic projections. So Fed Chair Powell noted that given the rapid nature at which events are unfolding, a forecast is, and I'm going to quote him on this, it's just not something that's knowable, and writing down a forecast did not seem to be useful. So keep this in mind as you're hearing projections in the financial media, and you try to begin to draw your own conclusion. Headlines from now and even going forward, they're going to be prone to be incredibly deceptive. So we now know that the GDP decline collectively will almost certainly be greater than what happened in 08 to 09, which was a cumulative 2.7% contraction. The IMF is calling for a 5.9% contraction this year, followed by a 4.7% expansion in 2021. So stacking up that 5.9% contraction and trying to compare it to things like what happened in the Great Depression, which is a cumulative 26.3% U.S. GDP decline, it's not only a ridiculous comparison, but it's a relatively reckless comparison, both in terms of scale and duration. So if you're looking for the second worst case scenario outside of what happened in the 30s, we also had a 13.5% GDP decline in the mid 40s. So this is not going to be the next Great Depression. You know, the makeup of the economy has significantly changed over time, and as of the tools that we have in our toolbox to manage through these periods. So we're going to look ahead to continued volatility and uncertainty, and we're not going to say that anything's been solved. The situation will be fluid, but we're fairly confident that this is an environment that's going to bring some significant opportunities for investors. So I'm going to pass it off to Andy for an update on our equity strategy, and we'll focus on moving forward.
Thank you, Adam, and thank you, Lowell. So before we get talking about the main purpose of my presentation, which will be an update on our size and style responsive U.S. equity strategy, I wanted to briefly discuss the master portfolio, because we consistently, after these webinars, have gotten some feedback from clients that they want to see that addressed more directly. And to give some of you who may not know some background, the master portfolio is the original U.S. equity strategy that the Bernie Company founded way back in 1974. And actually, our SSR strategy grew out of the master portfolio and has today grown to be the dominant strategy that we use across our clients. But we still do utilize the master portfolio as well. And the key difference here is that the master portfolio is actually a completely different strategy and a different approach from a lot of the things we talk about when we're talking about shifting between size and style. The master is more of a systematic approach. It's very much rules-based. And it's looking to buy the types of stocks that share the factors with stocks that have done well over the long term. So that means it's looking for stocks that are profitable, that have shown decent growth rates, but it also has a large value tilt to it and a very strict value screen. So because it is so rules-based and our signals don't really change all that frequently, there is a lot less turnover in this strategy. In fact, if you look at the holdings today, there are certain stocks that go back to the 90s and early 2000s that are still being held in the master strategy. So given that we're going through all this volatility, it's gone through a lot of volatility in the past, both in the last decade, going back to 2008, and really the lack of change is more a feature than a bug. It's just a different approach at investing. Really, the master portfolio is meant for only the most patient of investors who are willing to sit through time periods like we just went through, to stay invested towards the types of things that have been shown in academic studies to do well over the long term. So a great example is the master portfolio did not participate in the dot-com bubble burst. It did not chase those tech stocks in '99. And as a result, it was well positioned for the bubble burst. So as stocks dropped 30% from 2000 to 2002, the master portfolio actually rose double digits in that time frame. So this is a long way of saying don't expect a lot of change. Some of the things that we talk about when we're talking about the rest of this presentation are going to apply to the master portfolio, specifically about why we are tilted towards value right now. But I wanted to touch on that here at the start before we got into size and style, because that is going to be the majority of the presentation. So with SSR, the question is, where are we positioned right now? If you attended our last webinar, we went through exactly where we're positioned, and we were tilted towards value at the start, and we're still tilted towards value right now. In fact, we'll see that value has been a little bit disappointing, but we remain confident in this positioning, and we're going to share why that's the case. There were two big changes that happened in March as a result of the market sell-off. And these are two big changes that really we have to be patient on. We know that in market sell-offs, there's not really a whole lot, there's a lot of guessing, right? As Adam showed in those other slides, there were huge up days and there were huge down days, and trying to time that was really a fool's errand. So the best thing to do in that type of a situation is just to hold tight. But big crises create big opportunities. So the two big opportunities that we're utilizing now is one, at the end of March, we put on a new tilt towards small caps. And if you want to go back more in depth as to why we're doing this, our last webinar is a great resource where we explained exactly how small caps tend to lead the recovery coming out of market crises. Okay, and please keep in mind that when we're talking about weighting towards large caps or small caps, there are more small cap companies in terms of number, but large cap companies actually control somewhere between 75 and 80% of the overall stock market. So when we talk about tilting towards small caps, a neutral tilt will be 75 to 80%, but the beginning of a tilt, like what we're doing now, is going to be something between 65 and 70%. So you're still going to own more of the large cap companies in your portfolio, but relative to the market as a whole, we're beginning to shift towards small caps. And the other big change is the special stock selection model that we put online only during times of crises. We call it Recovery Score. And again, I'm not going to go too in depth on this presentation as to what exactly that is because we covered it in our last webinar. But generally, our normal score system looks back at past normal markets and builds models that are predicting which stocks will do well moving forward. The recovery model does something that's a little bit different. Rather than looking back at past normal markets, it looks back at past crises and figures out which stocks did well in the recovery, and then builds models based on that. So whereas our normal score model you might think of as finding high quality companies, the recovery model is going to have some of that, but it's going to be more heavily tilted towards technical factors, things like momentum. And one quick point here that I want to make, because as Adam mentioned, the Fed is not presenting any forecasts right now because they don't know. And I think that that's the best answer for anyone when they're talking about the stock market. Did we find the bottom back on March 23rd? Maybe. Could we go lower than that? Maybe, right? Anyone who's telling you that they know that answer for sure is probably fooling themselves and trying to fool you. So the key thing is when we talk about these changes that we're being made, we're cautious in our approach. We're not wholesale flipping portfolios all at once because we acknowledge that things could go up or things could go down. Rather, we're taking a measured approach here. And as we gain more confidence that a true economic recovery is underway, then you'll see us tilt more towards small caps and utilize recovery score more. But for now, we're beginning that rotation, but there's still other waves to come. So I wanted to break down, put a magnifying glass on the U.S. stock market here, just to show if we could pick up on some trends. So most people, when they casually ask about the stock market, are really referencing the S&P 500. And really, things in the S&P aren't that bad right now. Sure, minus 30% hurt. But if you told me back in January that the U.S. economy would be shut down and we'd all be locked inside our homes, I'd assume the stock market would be doing much worse than minus 12% year to date, which is where it is right now. So this is just another example that the S&P 500 really isn't the whole market. Here we've put the small cap Russell 2000 on the screen as well to show that there are other places where conditions are worse. So while the largest 500 companies are holding up well, all things considered, these smaller 2,000 are faring much worse. They were down something like 40% at the trough and are still down nearly 30%. So I wanted to point this out because when we talked about shifting towards small caps in our last webinar, this is one area where we've gotten the most questions on since. And the pushback tends to go something like, well, people aren't spending money because they're locked in. Businesses are locked down. Larger companies are better able to survive a drop in revenue. There's more risk with small caps. How are these smaller companies going to survive, and why would you want to invest in them? And my answer to that is that concern is 100% correct. Yes, smaller companies are at a bigger risk of going belly up. That's why they're so much cheaper today than large caps. That's why they sold off more. But that's also why there's more upside potential. It's true that when the tide goes out, we're going to see who's been swimming naked, and there will be companies that fail. But there are also plenty of of quality companies that have seen overreactions to their share price. And what we aim to do when we talk about putting on a recovery model is we don't use that all alone. We take our normal model, which is screening on quality, and we take our recovery model, which is screening on the types of companies that we see upside in the recovery, and we mesh those two together. And I think that overlap of the two models is where there's great opportunity to find those quality companies. But size is not the only part of our strategy. Style is just as important. And even amongst large caps, the performance distribution has not been even. So large companies are seemingly near impossibly even at break even on the year. But that's not the case with large value, where the performance has been much worse. This is primarily a quirk that the types of sectors that were less affected by the shutdown tend to be more growth oriented. So your healthcare and your information technology sectors, where there's a heavy weight of growth companies, have held up relatively well, while we've seen big drops in energy, materials, and industrials that all skew value. Small caps show a similar trend. So small value took a much larger drop than small growth. Small growth looks more like large value, but small value actually took something near a 50% haircut during the worst of it and remains down the most. These are year-to-date numbers, and they might be skewed somewhat because there was uneven performance of stocks back in January and February when large growth again did well. So I also wanted to show how things look peak to trough during this crisis. So if we isolate just on that time frame, we can see that everything sold off by 30% or more, but we still got that similar pattern. Large growth doing relatively well, small value significantly lagging. In the recovery, though, we've seen a different pattern. The rebound has been fairly uniform so far. Everything's basically rising together. Small value was actually the best performing asset class for a time there in early April, though it gave up some ground more recently. But these returns are clustered so closely together, there likely isn't a statistically significant difference between them. So, given that value sold off more than growth in the sell-off and isn't rebounding more strongly yet, why are we so confident in our value tilt? Well, the answer is relative to growth, value is as cheap as it ever gets. If we look at standalone valuation metrics like a PE ratio, a PE of 15 or 20 or 25 doesn't mean much alone because higher or lower valuations can be justified by level of interest rates or other economic factors. The better thing to do is to compare the price of value relative to the price of growth. And that's what we do here. So this chart is showing the price to intrinsic value of all the growth companies we analyze relative to the price to intrinsic value of all the value companies we analyze. Translated over into English, we're looking at the price to the fundamentals of growth companies and the price to the fundamental of value companies, and then comparing the two together. So it normally would make sense that growth companies are priced at higher valuations than value companies. They tend to grow more and thus earn higher price multiples, but there are limits. And the difference today between value and growth is more than 2 standard deviations away from the average. Value is more than 2 standard deviations cheaper than it typically is relative to growth companies. In fact, this is some of the largest differential we've seen since the 2000s. And what we expect when things get this far off from normal is we expect some regression to the mean. If you believe in buying low and selling high, now is the time to sell growth and buy value. We're not the only ones who are finding this result. This data comes from O'Shaughnessy Asset Management, which is an asset management firm that conducts and shares a lot of research. And they show relative value in a slightly different way than we just did. They're simply taking the difference in the earnings to price ratio of growth companies versus value companies. And what they find is growth is priced at this much of a premium relative to value only 1.7% of the time. And historically, when value is this cheap relative to growth, small value underperforms large growth by about 17% annually over the next 10 years. Another look at it is this data comes from Ben Carlson, who is a prominent blogger and podcaster and works at another RIA in New York City. He looked at the small value returns following every bear market since 1926. He found that over the next 1 year, 3 year, and 5 year time frame, small value substantially outperforms large cap companies. So I know small value specifically is the most beaten down asset class right now, and it's psychologically difficult to buy stocks that are that oversold. It's why the adage buy low, sell high is easy to say, but hard to do. And really, bull markets can be difficult because they don't tend to follow the fundamentals. Hot stocks and sectors stay hot, while traditional factors shown to correlate to long-term excess returns often take a back seat. But bear markets are where these factors tend to shine. This is an historic crisis, but with historic crises create historic opportunities. And that's what we aim to take advantage of when we talk about shifting towards small and staying tilted towards value. So with that, we want to leave the discussion about the investments. And I know we're running a little bit long right now, which we thought we might, but I'm going to shift over now to Adam to talk about some of the legislative changes that have occurred during this crisis to keep you all up to date.
Great, thanks, Andy. And as part of the stimulus we discussed earlier, there was a business component to this and a personal component, and there's a lot of different layers, and I'm not going to be able to capture them all in just a few minutes, and especially not on one slide. But I wanted to extrapolate what we think are the three most important components of the CARES Act as it relates to our clients and their planning opportunities. So, the first piece of this is typically, I believe, almost fully processed by now. It's a recovery rebate. So it's checks to individual and families based on their income level, as a one-off stimulus payment. So those recovery rebates, ranged based on tax filing status and number of family members, but those have been distributed out and have been in motion for a couple of weeks now. So that's the first piece of it. The second is related to retirement plan changes, and I believe most important as we look at our overall clientele. The first being the waiver of the required minimum distribution rules for 2020. So if you're over the age of 72 and you're needing to take annual distributions from your IRA, which you then pay taxes on, the government has released that requirement for just this year. So the main takeaway there is if you don't need that money to live off of, then it might be of your interest to consider holding off and passing on it for this year to save those direct tax dollars. So you can pass on 2020 and then just pick up in 2021 where you left off. So you don't need to play catch up next year, so to speak. You'll just totally reset the clock and take another distribution next year as if it never happened. So, should you or should you not take your RMD for the year? That's number one. If you already took your RMD, please know that you might have the opportunity to return that back to the account. There's certain caveats to this that we can talk through with you on a one-on-one basis, but just know that if you're scratching your head saying, well, what do I do? I already took it. You might have an option to reverse that transaction. The other piece of retirement plan rule changes relates around distributions. So there's this special exception for what they call coronavirus-related distributions for this year. You can take up to $100,000 out of a retirement account. You still pay tax on it. You just don't pay the penalty if you're under 59.5. In relation to any disruption or hardship from COVID-19. So you can take that out and you can either return it within a 3-year window or you can spread the taxes out over a 3-year period. So if anyone's feeling like they need to get access to cash and don't have other sources to do so, that might be an option on a penalty-free basis and with some sort of a tax payment spread out over a couple of years. The third, as it relates to retirement plan changes, is they increased the loan limit on qualified plans from $50,000 up to $100,000 for the year. So they doubled it. So if you've got a 401k plan with an employer that allows you to take loans from the account, your employer allows that. Typically the limit was $50,000 and they bumped that up to $100,000. So that's another tool in your planning toolbox if necessary. The last piece of this, which is relevant from a tax management perspective, especially, is around charitable giving. So they included, as part of filing your 1040 for this year, a new above-the-line deduction of $300 for cash contributions to charity. So for those of you that don't itemize or haven't made any charitable donations, know that for this year, there's this $300 amount that can get deducted at the top of your tax return, up to that $300 limit as a tax savings opportunity. That's new, that was not there before. And the last piece is the adjusted gross income limit for charitable gifts has been eliminated for this year. So it was previously, there were caps on percentage of your adjusted gross income, whether or not you were giving cash or stocks. Those limits have been removed. So you can offset 100% of your income, essentially, if you make significant gifts to charity. So that's from a planning standpoint. If you have scheduled gifts, if you're giving over multiple years, let's say $10,000 a year, every year, and you plan to do that for the next 5 years, it might make a lot of sense to front load that to this year. In the event that your income's going to be lower and you want to have a really nice tax offset. So these are the tools that are available in your toolbox now. We did a blog post on this a couple of weeks ago that's on our website, but this is really something you want to talk in detail with your advisor around. I just want to make sure that I brought this to everyone's attention so they knew what some of the preliminary changes were. So on that note, I know we ran a few minutes over here, but we want to thank everyone for their time, and we welcome your follow-up questions. As always, we direct you first to your advisor on our team, and then second to our main office line if you need to get in touch with us. So thanks again, everyone, and stay safe and well.